I used to get worried every time there was a market decline. But I eventually learned that market declines are not actually a cause of worry, but a cause of celebration for the patient investor. Let me tell you why. Did you know that human beings tend to value losses far greater than our gains? This is called a loss aversion bias, which was researched and written upon by the famous Nobel laureate Daniel Kahneman and his associate Amor Tversky back in 1979. This actually has an evolutionary origin. You see, when we were cavemen, survival for us was way more important as compared to getting some food or water. Because if you lost your life, no amount of food or water was any good for you. I'm Varun. I spent the last 8 years in asset and wealth management industry, and I used that experience to gain financial independence by the age of 34. And today I'll be talking about how to make the best out of bear markets. Now, market crashes, similar to any other event in our life, has two ways of looking at it, the positive and the negative way. So let's take the negative side first. Yes, on the face of it, market crashes are a terrible event. They erase enormous amount of wealth from the share market for honest taxpayers and citizens who have invested their hard-earned money. Moreover, market crashes are always accompanied with a negative sentiment. Now, this sentiment can be for various reasons, which basically leads to the bear market or the correction. It can be excessive investment in a particular area, which turns out to be a bubble. There can be a weak economic condition leading to a decline in stock prices, or there can be an external surprise to the market, which can lead to a negative sentiment, such as the COVID crash. But for a long-term investor, the reason is not important. What is important is what needs to be done in such a situation. Another thing to note, from an individual investor's perspective, it takes more effort to recover the amount that you have already lost. Let me explain. Suppose someone loses 50% of his portfolio in a market crash. Now, if he realizes these losses, he would actually need to gain 100% on top of his actual value of investments just so that he can break even. But now let me flip this argument and look at the bright side. Market crashes are actually a part of the journey for a patient long-term investor. A crash or a correction can always worsen into the 1920s style depression. However, that does not occur very often. Actually, it's very rare. On the other hand, 20, 30, 40% corrections are actually quite common. If you look at the data, the S&P 500 has corrected 20% or more every 6 to 7 years. Nifty 50 similarly has corrected more than 20% every 4 to 5 years. Market crashes are necessary. They work as a cleaning event. They basically remove the excesses from the market, just like how a wildfire removes excess dead wood from a forest and makes the ecosystem more resilient in the process. But the patient investor who keeps their calm gets to invest in valuable assets at reasonable prices, which normally is not possible. Crashes are actually good. Although economic downturns and corrections last on average 1/5 of the time, this turns out to be a great opportunity for patient investors because wonderful businesses are available at reasonable prices, which normally does not happen during the normal course of market function. Another point here is that serious investors should realize markets are actually a reflection of human ingenuity. You see, human beings have innovated for hundreds and thousands of years, and because of these technological innovations, our capabilities and our consumption patterns have changed a lot. And the businesses which have been built on top of these technological innovations actually get listed in the public markets and be available to us for investments. And as everyone knows, eventually human ingenuity or innovation always wins. 2020 COVID crash was my first major bear market and I decided to stay out of it. I eventually regretted this decision because some of my best investment ideas were available very cheap at that time. And that's how I realized that being emotionally underprepared is the worst way to handle your investments. Obviously, no one knows when things will stabilize in such a situation, but having a plan always helps the patient investor. In the midst of 2008 market crash, Warren Buffett wrote a very inspirational piece called Buy America, I Am. The stock market still dropped 30% after this article was published. So he did not actually catch the bottom, but that's not important because he still made tremendous profit assuming that he bought at that point of time. It is often said that one should not time the market. However, in my experience, what makes market timing worth the effort is being prepared for bear markets. Now here is a small demonstration. Based on the study of Nifty 50 index since 1999, a regular yearly SIP resulted into an XIRR of roughly 13.7%. Now, if you managed to mistime your investments and invest at the market tops, you still made a decent 12% returns. On the other hand, if you actually invested at all the market bottoms, this resulted in an additional 1% return over the yearly SIP figure. Now, this is not a significant difference. However, the point is that investing during downturns helps an investor in the long run. All prior market crashes have recovered and people have continued to make returns well into the future. Not just that, a period of 1 year or 2 years from the market bottom have actually resulted in beautiful returns, as you can see in the table. Mature investors and fund managers have understood this mental framework very well and have taken benefit every time a downturn or a market decline happens. It is not just Warren Buffett. Many famous investors such as Seth Klarman, John Templeton, Howard Marks, and even some very famous Indian investors such as Rakesh Jhunjhunwala and Ramkrishna Damani have used market downturns to make some great investments. The key here is to detach oneself from the short-term market moves and focus on the difference between the intrinsic value of an investment and the value that the market is offering you. Now, although famous investors have grabbed amazing opportunities by being contrarian in such times of market panics, it is not always possible for everyone to be a contrarian and perform in a similar way. However, training the skill to think like a contrarian is obviously possible. Victorious warriors win first and then go to war is the famous quote from The Art of War. Now that we understand market crashes are very common, it is important to realize how to prepare oneself for it. According to me, there are 4 levels of mental preparations, and most of the investors are already at level 2 or 3, and what they should aim for is to go to level 4. Level 1 is survival. It is important to keep a calm mind. A panic response originates from the rudimentary part of human brain, which is called the amygdala. Now, these responses were relevant in the prehistoric times, but in the current day and age, we need to make a lot of complex decisions, and having a calm and composed thinking process helps do that. If you stop your SIPs, or even worse, if you withdraw your investments from the market and decide to stay in cash, you would not even be able to beat inflation, which is the primary goal of making these investments. Level 2 is protection. Taking excessive leverage works well during bull markets, but also kills your investments during bear markets. Hence, it is important to not take excessive leverage, especially because no one really knows how deep a bear market can be or how long can it last. Another critical point is to keep an emergency fund ready that you can dip into in the times of need during bear markets. Withdrawing from your investments should be avoided at all costs. Level 3 is discipline. Now here, focusing on portfolio rebalancing and maintaining regular SIPs becomes important. Portfolio rebalancing to the predetermined levels of your asset allocation takes care of buying at the market lows without the need of any more analytical effort. And regular SIPs help buying more units or more shares of the investments that you already believe in. Level 4 is offense. Here, you might consider adding more to your SIPs or doing lump sum investments if you believe that your portfolio itself is strong and resilient. You can also add new and stronger ideas to your portfolio if you already have a watch list and you are waiting for the right price levels. Now, I would not recommend this for everyone, but if you are someone who has high conviction ideas and you have the basics taken care of, wherein you have a regular income coming in, you have an emergency fund, and you have a proper portfolio allocation, then you might consider tapering down the debt or cash portion of your portfolio and adding more to the risky investment sides. Because again, bear markets need to be celebrated and your most high conviction ideas need to be bought aggressively. The first thing to do is to understand the severity of the correction or the bear market. If 20% corrections happen every 4 to 5 years, then 40 to 50% corrections are even more rare and call for a proportional response. Bear markets can easily be recognized based on the price movements of the major indices because they convey the market sentiment. Another indicator is the Nifty PE ratio, which often falls below the long-term average during such periods. The next thing is to have a clear understanding of what kind of an investor you are. Do you fall under the conservative, the moderate, or the aggressive category? Since this should basically decide your next course of action. We have already covered the 4 levels of preparedness in the earlier section. I would recommend level 1 and 2 as the basic for everyone. Actions in level 3 become important for people who are in the retirement phase or who have a very low risk profile. Actions in level 4 would be recommended for someone who have a moderate or an aggressive risk profile. For people who actively pick stocks, you can look for companies with healthy balance sheet, stable demand, consistent earnings history, and a leadership position in their sectors. Banking, FMCG, pharma, and IT companies are often monitored during such periods because they have a long operating history and a rather stable demand in the economy. Highly indented companies, weak cash flow businesses, speculative penny stocks, and companies who are dependent on external funding often struggle during market crashes and hence should be avoided no matter how cheap they look. One last thing to note is that people who already have a sizable investment can do tax loss harvesting. That is, book some losses which can be carried forward for 8 years and offset the capital gains that you would be booking in the future. Now, obviously, you need to be aware of the relevant tax rules while doing tax loss harvesting. Along with good things, it is also important to note the things that you should not be doing because they do not work for you in the long term. Apart from things that I have already covered, I would like to add 3 more points here. Do not watch financial news very regularly because this will keep you in panic mode and force you to make rash decisions. Do not be a forced seller. By that, what I mean is, do not invest the money that you know that you will need in the short term. Always keep an emergency fund ready. Do not switch between a trader and an investor mindset. Now, what do I mean by that? Many people are neither full-time traders nor long-term investors. They are somewhere in between. This does not work well because they pick stocks and then panic during the bear markets. Having a conviction which is either developed by yourself or bought from professionals becomes the key here. If you have made this far, I would request you to hit like and subscribe. My goal with this channel is to bring you unique insights with all things money, personal finance and investing, drawn from my own journey to help you make a better investor. Long-term investors should remember the wise words of Benjamin Graham and Warren Buffett. The stock market is a device to transfer money from the impatient to the patient. Mr. Market is a panic depressive which offers you different prices every day according to his mood. Whatever your investing personality is, conservative, moderate or aggressive, market crash is beneficial for everyone if there is a plan and framework in place. Now please note that you do not need to sit in cash waiting for market crashes. Rather, if we just normalize the basics every time and focus on the upside over the long term, our portfolio will do much better.